Hi guys, hi all. You okay? Guys, can you hear me? The weather is pretty bad in here. Good evening, but I'm sure it will not have any. We might not have any issues. Okay, super. Okay, right. Good evening. Good evening. Good evening, everyone. Welcome to another session of What FR Marathon, and here we are. So basically, I got a lot of positive feedbacks yesterday. Thank you very much for the feedbacks. And today, as we discussed, we are moving on to consolidation. Okay, let me get my keypad working. Give me a moment. Yeah, we are good to go. There you go. So we are looking at consolidation, and we are looking at simplifying consolidation, right? So we are going to see how we can simplify consolidation. So I'm going to give you a little background, and then of course we are going to start off. Okay, brilliant. Where are we? There you go. Okay, I'm doing this. What did I do? Okay, anyway, that's fine. Okay, brilliant. Coming back, consolidation is not one. It is one of the major area in your syllabus. It is tested. It will be tested. It can be tested for minimum 15 marks, maximum to about 20 marks. It will be tested in every exam session. And there you go. It can come in any part of the syllabus. IFRS 10 covers consolidation. Consolidation is about bringing together two or more companies and bringing together and preparing one set of consolidated financial statements. That is consolidation. Now, guys, when you take consolidation, one of the primary areas that I want you to know is yes, bringing two entities together in terms of consolidated financial statements, consolidated income statement. That is one area, and also there is associate that can be tested. So you need to know consolidated income statement and balance sheet. That is one area covered by IFRS 10. And then IAS 28 covers investment in associates. Okay. So basically, what you need to do is you need to be able to work on income statement, work on balance sheet. Sir, can you work out the pyramid sum? No problem. But I think pyramid is only balance sheet. So as a starting point, what I will do is I'll do where you have income statement and balance sheet. And then maybe as another alternative, I can do pyramid during our marathon session itself. No problem there. Super. Because I want to have already picked a question, which is going to cover both income statement and balance sheet. First way to get that background. And then we'll try to work on a question that you give me as well. No problem. That's fine. So, and then I want to do a question which can obviously cover IAS 28 investment in associate as well. So that I'm covering, I'm trying to cover everything given this minimal time period that we have. Okay. So with consolidation, some of you who have been with me, you know the shortcuts, the steps that I use. So I'm going to quickly take you through the steps once again, so that the ones who are new for our session are also in par with what they have to do. Brilliant. So when it comes to consolidation, guys, I'm going to give you some shortcuts, right? And I want you to make sure that you are in line with these shortcuts, because this is definitely going to help you for your exams, right? Okay, super. Now, let's look at the shortcuts. It's very simple. Wait a moment. I'm getting some messages. So I'm finding it difficult to join. Okay. Well, that's okay. Right. We are good to go. Okay, guys, in the exam, what I want you to do is I want you to leave about 40-50 lines. In the exam, I'm going to show you how exactly you have to work around the question, but let me show you, right? First of all, consolidation, shortcuts. These are the things that you need to keep in mind when you are doing a consolidation question. Okay, super. Step number one, always draw the group structure. You need to understand the group structure. You need to know who is acquiring whom. Parent, subsidiary, associate, you need to know the relationship with NCI. Step number 2, I want you to take the reserves. When I say reserves here, I'm talking about retained earnings and revaluation reserves, retained earnings and revaluation reserves at balance sheet date. Now, guys, this is where most of the students go wrong. You have to take it at balance sheet date. Retained earnings and revaluation reserves as at the balance sheet date. Balance sheet date means year end date. So that is very, very, very crucial. I want you to make sure that you don't mess up there. Step number 3. Step number 3. You are going to go to the top, add assets, and liabilities. Now, when you add assets and liabilities, you have to leave space. You have to leave space because this we are going to work this a bit later. You have to leave space for goodwill on acquisition. You have to leave space for investment in associate. Okay, you have to leave space for goodwill on acquisition. You have to leave space for investment in associate. Don't worry, I'll do a question with you today itself. Leave space for consolidated retained earnings. Number 4, consolidated revaluation reserves. Number 5, non-controlling interest, NCI. So you're going to leave space for all this on top when you are doing the line by line addition. Once you're done there, step number 4. Step number 4. Your examiner will give you some notes. Now those notes will be adjusted. So it becomes adjustments. So from notes, it will become adjustments, notes to adjustments. Okay. Now you need to know few things. What are the common adjustments that can be tested for you? Number 1, intergroup transactions. Any transactions between the parent and subsidiary. Parent can sell goods to subsidiary or subsidiary can sell goods to the parent, has to be eliminated. Any transaction. Any loans between the parent and subsidiary has to be eliminated. Dividends, interest payments, finance costs, all those are going to be eliminated. So very important, you're going to eliminate loans, dividends, interest on between transactions between the parent and subsidiary has to be eliminated. So point number 1 below that, any intergroup transactions between parent and subsidiary will be eliminated. For example, loans, transactions, dividends, interest, etc. Are we clear? Okay, that's the first thing to keep in mind. Second thing, you will have adjustments for intergroup transactions. You will have something called items in transit. Items in transit means one party has sent goods or cash, the other party has not received it. So basically, you have to put up a little equation. You're going to put up a little equation and you're going to eliminate this. What is the equation? Intergroup trade receivables minus cash in transit. Yeah. Cash in transit minus goods in transit gives you intergroup trade payable. So you're gonna less this in the equation, less this in the equation. But when you're going to take it to the financial statements, this is going to be eliminated from trade receivables, meaning deducted. This is also eliminated. This is added, and this is added. The financial statements, that's how it will be. Consolidated financial statements, that's how it will be adjusted. Guys, keep in mind. And next point, uh, fair value adjustments. There can be fair value adjustments like revaluation. So you got to make sure that you account for it. Next, fixed asset transfers will also be eliminated. The parent would have transferred fixed assets to subsidiary, or subsidiary would have transferred. It has to be eliminated. If there's any additional depreciation, that should also be accounted for. Are we clear so far? And then, of course, you can have unrealized profits. This is normally tested in every exam session. 1, 2, 3, 4, 5. Or your examiner can connect you, or your examiner can connect this to a scenario, to a standard. So connection to an accounting standard is also possible. Now you need to know, step number one, always put up the group structure first. Step number two, reserves at the balance sheet date, very, very important. Step number three, add assets and liabilities, leaving space for all this. And number four, adjustments. But when you do these adjustments, it can get connected to an accounting standard, like I just told you, or very, very, very important. Everything at goodwill, everything at acquisition must be noted. So you are going to note everything at acquisition has to be noted separately so that you can adjust when calculating goodwill, because goodwill will be affected with any adjustments to at acquisition. Whatever is happening at acquisition will have an impact on the goodwill figure. Now that is done. Number 7, very straightforward. Calculate consolidated retained earnings, NCI share of net assets, NCI share of net assets, consolidated revaluation reserves, anything else? That's it. Yeah, there you go. So like I told you, retained earnings at acquisition, adjustments at acquisition is very, 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 very important. Are we clear so far? Yes or no? Are we clear so far? Yes or no? Everyone? Are we clear? Are we clear? Okay. Now, what I'm going to do is I am going to do a question with you. While doing the question, I'm going to explain the adjustments, possible adjustments that can be tested for you in the exam. Okay? Yeah. Brilliant. Well, like I told you, I have picked a question which has both income statement and balance sheet. So Polestar is a question which has both income statement and balance sheet. I'm going to start off with this question. So consolidated income statement also I can cover, consolidated balance sheet also I can cover. Okay. Okay. But before we start, your revision kit itself says, note that the level of work required to answer this question is beyond that to be expected within the current exams. Okay, your current exams, you're not going to get something at this level. You're not going to get. Okay, because this is going to be a bit too much for the level right now. However, it provides a proper revision before the exams. So it provides a useful revision exercise as it tests both statement of P&L and statement of financial position. Something detailed as this will not be tested in the exam, but it's okay for us to understand tiny areas in a deep manner so that we are prepared for the exams. So when you go to the requirement says prepare the consolidated statement of P&L for Polestar for the year ended 30th September 2013 and prepare the consolidated statement of financial position for Polestar as at 30th September 2013. Okay, now what I want you to do is very simply, forgetting everything, Take it easy. All what I want you to do is you come here. In the exam, you're going to have something like this, right? You will be having something like this. So I got stuck in this question, sir. Good that you picked this question. Okay, you got stuck in this question. Brilliant. Okay, don't worry. Hopefully, we can figure it out together. Okay. Brilliant. So in the exam, you are in the examination hall, you have a question like this, income statement and balance sheet put together, it's going to be a lot. You need a lot more space. So I want you to leave at least about 50 to 60 lines. You come here, right to the bottom. And always, 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 you need to remember to go back to the shortcut, what I have asked you to look into. Now, first thing I say, always draw the group structure. Okay, now first thing would be your workings. When you come here, working number one, group structure. Working number one is group structure, meaning who has acquired whom. Okay, before that, before I take you through the entire question with me, like yesterday, I want you to read the question on your own. I want you to read the question on your own and understand few things so that we can work around it together. Okay, I'm going to give you about 5 minutes to go through the question on your own. Okay, start. In between, I'll fill some water for me. In the exam, you have to be quick in going through the question. Okay. Guys, can we? Are you done? Are you done? Everyone? Can I? Okay, brilliant. Now, guys, in the exam, you know what is required from you. What is required from you? You know the steps that I've given you. I want you to be in line with the steps. That's enough, more than enough. Okay. Based on the steps, the very first thing that you have to identify, based on the steps, the very first thing that you need to identify is the group structure. Okay, let's go back. Let's say on 1st April 2013. Okay, one thing in the exam, very, very, very important thing, your dates. 1st April 2013, immediately you see that you come here 30th September 2013. Okay. On 1st April 2013, Polestar acquired 75% of Southstar. Polestar parent acquiring 75% of Southstar. When is this happening? On 1st of April 2013. Okay, listen to me very carefully. Your year end is 30th September. In other words, let's put up a little graph, a little, not a graph actually, a little timeline. Your year end is 30th September 2014, correct? 30th September 2013, I'm sorry. So basically 2013, you would have started from 1st of October 2012, correct? 1 year, no? Are we clear there? 1 year, no? So from 1st of October 2012 to 30th of September 2013. But the company was acquired when you're acquiring the company on 1st of April 2013, meaning during the current year, Polestar is acquiring Southstar. So when is that happening? If you technically see, that is happening here. 1st of April 2013. Are we clear? So during the current year, the acquisition is taking place. Guys, if the parent, point to know, if the parent acquires a subsidiary during the current year, like this in this case, during the current year, if the parent acquires a subsidiary, we call it a mid-year acquisition. A mid-year acquisition. If it's a mid-year acquisition, very importantly, you have to keep in mind all incomes and expenses of subsidiary will be time apportioned. Time apportioned for 6 months, meaning only from this point onwards, all the income and expenses will be given to the subsidiary. Subsidiary's results will be consolidated to the parent in the income statement. Balance sheet, you don't have to worry anything because as at that point, everything belongs to the parent. Are we clear, everybody? Did you understand that? Yes or no? Did you understand that? Yes or no? Everyone. Keep responding. Take it easy. Super. Now, let's go to the top. Polestar acquired 75% of Southstar. Southstar has been experiencing difficult trading conditions, tough conditions, that's okay, and making significant losses. In allowing for Southstar's difficulties, Polestar made an immediate cash payment of only 1.5 per share. Okay, now coming back, IFRS 3. IFRS 3 is applicable for goodwill calculation. IFRS 3 says, business combinations device says, if a parent is going to acquire a subsidiary, the parent can only make payments in 3 mediums, in 3 models. What are the 3 models? Number 1, immediate cash payment. You immediately pay cash. Number 2, deferred payment. Deferred payment means you don't pay cash immediately. You come to an agreement. You say, the owners of subsidiary, okay, I'll pay in 1 year's time, 2 years' time, 3 years' time. Therefore, if you are going to agree in 2 years' time or 3 years' time, you have to calculate your present value. Right now, what is the value? Your present value equals future value over 1 plus r to the power n. That is the thing. On number 3, what you have to do is you can go for a security exchange. A security exchange is a loan note exchange, or you can go for a share exchange. You give shares and you take shares from the other company. Are we clear? Are we clear? Now, in this case, guys, what is happening? In allowing for South Star's difficulties, Polestar made an immediate cash payment. You are making an immediate cash payment of only 1.5 per share. In addition, Polestar will pay a further amount in cash on 30th September 2014. You're acquiring on 1st of April. So you are going to pay on 30th September 2015. 14. If Southstar returns to profitability, that is only if subsidiary returns to profit by that date. Now, let's say even if you know that it's not going to become profitable, it's okay. Right now, IFRS 3 says you have to recognize. No matter what happens, that doesn't affect you. It doesn't make profits, it doesn't affect you. You are going to recognize it today. Are we clear? Today. The fair value of this contingent consideration, because you are going to delay the payment, you call it as a contingent consideration. At the date of acquisition was estimated to be 1.8 million. Now, when you acquired, you thought you're going to pay 1.8 million. They're giving you the fair value, meaning the present value is already calculated. You don't have to do anything. But at 30th September 2013, guys, as at this point, year end, the contingent at 30th September 2013, in the light of continuing losses, the value was estimated at 1.5 million. You thought you're going to pay 1.8 million, but what's happening as you go on after the year end, you see, okay, no, it's not worth it for 1.8 million. I'm going to pay only 1.5 million. You thought you're going to pay more, so you recognize more, but your liability is coming down. A reduction in liability. In other words, you have a reduction in liability. What is a reduction in liability? A reduction in liability is an income or an expense. A reduction in liability is an income or an expense. A reduction in liability is an income or an expense. It's an income. It's an income. An increase in liability is an expense. A reduction in liability is going to be an income. So you will have an income. Okay. Overall, directors of Polestar expect the acquisition to be a bargain purchase, leading to negative goodwill. Now, what is goodwill? Goodwill is the premium paid. You have the net assets. On the value of the net assets, when you pay a premium, something extra, it becomes goodwill, positive goodwill. But let's say you have, I have this keyboard, right? I have this keyboard, right? Or net assets, whatever. I have net assets. On the net assets, I pay a lesser amount. When I pay a higher amount, it is goodwill, a premium. When I pay a lesser amount, it is negative goodwill. Meaning it's not technically a premium paid. In other words, I bought the company at a discount. If I buy the company at a discount, we call it, it's a bargain purchase. I'm bargaining my purchase. IFRS 3 says, listen to me very carefully, IFRS 3 says, if it's positive goodwill, to show in the financial statements. If it's negative goodwill, you do not show in the financial statements. However, you will calculate it. Now, here they say it could be negative goodwill, but you have to calculate. Okay, it's not, you can't be in a position where, okay, you say, no, I'm not going to show it in the financial statements. I'm not going to show, I'm not going to calculate it. No. You have to calculate it. Since it's a bargain purchase, it becomes an income. It becomes an income. It becomes a gain. This gain is added to retained earnings. Are we clear? Are we clear? Are we clear? Okay. Now these are for explanation purposes. Okay. Akash, it's a gain. Because it is a gain, the value is 100,000, but I buy it for 80,000, means I make a 20,000 profit, no Akash. This 20,000 profit is a gain, therefore I add it to retained earnings. It's an income. I'm going to show it to you as we do this calculation. Okay, like I told you earlier, look here. Here, in this case, in the exam. Now, guys, those are my explanation, okay? This is how I want you to approach in the exam, okay? Now, always draw the group structure. I want the group structure. That's where I am. Now, tell me based on this, what is the group structure like? Polestar is acquiring Southstar 75%. So in the exam, I'll say Polestar acquires 75% of Southstar. Polestar is the parent, Southstar is the subsidiary, and then you have 25% NCI. I got my group structure done. Also, you need to mention it's a mid-year acquisition. This is for your reference only. Okay. Done. What is my second step? My second step is reserves. I need reserves, retained earnings. Whose retained earnings? Both parent and subsidiaries, both. So I come here, working one done, working two, reserves. Working two is my reserves. So I come here. I'll say I need Polestar's reserves. I'll need South Star's reserves, both. So both in terms of what? In terms of retained earnings, I need also revaluation reserves. I need both. Okay, I told you I need reserves at balance sheet date. Always, always, always. Make sure you get it at balance sheet date. So guys, don't miss that. This has to be at balance sheet date. Are we clear? At balance sheet date. Are we clear? Are we clear? Are we clear? At balance sheet date. So I come here. I need retained earnings at balance sheet date. So I will go to the question. Now here is the question. Now here, your balance sheet date is when? Your balance sheet date, guys, is 30th September 2013. Therefore, I have 28,500, 12,000. Are we clear? Sometimes your examiner can have the opening retained earnings plus current year profit. Your examiner can do that. In that case, you need to add and take the total. Okay, you need to add and take the total. Now, in this case, 28,500 from balance sheet, 28,500 and 12,000. And then, do you have any revaluation? You don't have any revaluation. Therefore, your revaluation is going to be 0. Guys, are we clear? Understood? Yes or no? Are we clear? Understood? Yes or no? Brilliant. Let's go further. Always, always, always my steps. So step number 1 done. Step number 2 done. I'm moving on to step number 3, which is adding assets and liabilities. But when I add, I'm going to leave space. I'm going to leave space and I'm going to add, take my assets and liabilities. Clear? Okay, brilliant. So let's go back. In the exam, it will look like this. There you go. I can go to the top. I can start with balance sheet and do the income statement, or you can start with the income statement and the balance sheet, no problem when it comes to consolidation. So I'm going to say Polestar's statement of financial position as at 30th September 2013. Okay. Now I'm going to add my assets and liabilities from here. In the exam, you have the option, the privilege of copy paste. You can copy paste. But here, I'm just going to simply take it from there. I'm going to take assets, non-current assets. Please don't take any shortcuts here. Please don't say NCA. Please take the entire full form here. But in your workings, you can have your shortcuts, no problem. So you can have your property, plant and equipment, and then you have your investments. Your investments will result in goodwill on acquisition. Remember, I asked you to leave space for goodwill. And then I also ask you to leave space for investment in associate. Now, if you look here, leave space for goodwill, leave space for associate. When I come back here, my property, plant and equipment equals 41,000 plus 21,000. There you go. My investment value is equals 13,500. My goodwill, I have not calculated it, so I'm going to leave it empty. My investment in associate, I have not calculated it. I'm going to leave it empty. And then I'm moving on. My current assets. When you take my current assets, I have equals 19,000 plus 4,800. Therefore, my total assets is this. Are we clear? Are we clear? Okay. Next, I have my equity and liabilities. Under equity and liability, I have my equity shares. My equity shares, guys, in the exam, always, please take your parents. Don't take subsidiaries, always parents. And then you're going to leave space for consolidated retained earnings, consolidated revaluation reserves. You're going to leave space for NCI share of net assets. These are things that you have to leave space for, like I told you here. Please make sure you leave space for them. Then you move on. You can take your non-current liabilities, no non-current liabilities. So current liabilities. So you can take your current liabilities, and that is equals 15,000 plus 7,800. There you go. That's your total assets. This is your total equity and liabilities. Now that is done. And then you go back and statement of P&L. So Polestar group of companies, consolidated statement of profit or loss for the year ended. Our year end is 30th September 2030. There you go. And below that, I've got my statement of profit or loss. There you go. That's done. So I have my revenue. That's done. I have my revenue. That's right, Nivedita. That's right. So I have my subsidiary for 6 months equals 110,000 plus open brackets. Be very careful. Into 66,000 into 6 over 12, 143,000. Next, I have cost of sales. This is my cost of sales equals 88,000 plus open brackets 67,200 into 6 over 12 into 6 over 12. Make sure you do that. Okay. Next, gross profits equals this minus this 21,400. And then you have your operating expenses. Your operating expenses are equals 8,500 plus open brackets 4,400 into 6 over 12. Next, profit before tax. So we have our profit before tax, and then we have our taxes. I've taken the operating expenses, right? Profit before tax, and then I have my taxes. So if you take our taxes, equals, so it's a minus 3,500 plus 1,000 into 6 over 12. So minus 3,500 plus it's 500. So minus 3,000. And therefore I have my profit after tax. Are we clear? Are we clear? Guys, everybody, are we clear? Yes or no? Brilliant. Now guys, okay, you have to be very, very careful. Now you're here, your workings are done. Come back to your steps. You need to know the steps. Now I'm working myself with the steps. Step number 4, my adjustments. Adjustments means everything that I have to adjust from the financials that I've been given. Now here, I'm going to start working on my adjustments. So let's start off. Whatever I require from here, I'm going to plug it here. So working number 2 done, working number 3. Here they say on 1st April 2013, Post acquired 75%. That's done. So S has been experiencing difficult trading conditions. No problem, done, making significant losses. In allowing for South Star's difficulties, Polestar made an immediate cash payment. So your investment cost. So your investment cost, you've got immediate cash payment. They say immediate cash payment is 1.5 per share acquired. So they say clearly here, they're paying 1.5 per share acquired, 1.5 per share acquired, correct? So that's going to be my investment cost, right? So how will I calculate that? In total, my subsidiary has how many shares? 6,000 shares. So equals, in the exam, equals 6,000 shares, 75% I'm acquiring. For every share that I'm acquiring, I'm paying 1.5. So, there you go. So that's 6,750, correct? Okay, hold on. There you go. Equity shares 50 cents per share. So therefore, yeah, good one, guys. Good one, good one, good one. Brilliant. So total number of shares would be 6,000 divided by 0.5, 12,000 shares in total. Okay, good one. Super. Well done, well done. Take it easy, take it easy. Screen is blurred. Is my screen blurred, guys? Is my screen blurred? Probably there's a lot of rain in here, so probably because of that. But others, my screen is blurred. Oh, what do I do? I have connected myself to the faster. The PDF is unclear. Okay. Now, any better? Wait. Now, any better? Others, everyone? Now the Excel sheet is unclear. Okay, let me try to get a balance now. Life is difficult sometimes, isn't it? Let me check. Yeah, it's a bit unclear. Excel sheet is unclear. Okay, I'm trying to have a look at it. Okay, is it the internet that is the problem or what is the problem? Just a moment. Guys, is it clear now? Can you hear me? Reachable. Do you see my screen now, everyone? Better? And superb. Probably because the weather is very bad in here. Even now, it's not great, huh? Better than before, right? This way better now. Okay. Thanks. Okay. Right. Sorry for the inconvenience. Yeah. This is part and parcel of life. These are uncontrollable factors, right? Uh, but guys, basically, you also should understand it works both ways. My internet connection has to be also strong. Your internet connection has to be also strong for you to get the output, the better output, right? Okay. Anyway, so 12,000 shares we have in total. So we know here, you're paying 1.5 per share acquired. So therefore, you're acquiring equals 12,000 into 75% into 1.5 per share acquired, 13,500 in total. Everybody got it? Everybody, you're getting it? Yes or no? 13,500 in total. Guys? Okay. You debit investment cost. You're paying cash, so you credit cash. So technically, you have to debit investment cost. Your examiner is saying here, look at this. The fair value, it's also okay. The fair value of this consideration, wait. Okay, the contingent consideration, your examiner clearly says, okay, the contingent consideration has not been recorded by Polestar. So meaning your cash payment has been recorded. Your immediate cash payment has been recorded, and it is also reflected when you see here. It also shows here 30,500 here. When you come here, it is recorded. So you don't have to do anything there. So you can just take it because it is relevant for your goodwill. Okay. Second, number two, you have a deferred payment. They say the deferred payment is 1,800. Again, well, you thought your present value was 1,800, but year end, the value you have has come down to 1,500, meaning a 300 decrease. A decrease in liability of 300 is obviously a gain. So guys, look here. They say the contingent consideration has not been recorded. So obviously what you are going to do is, number one, you have to go and record this. Okay. So first and foremost, what I'm going to do is I'm going to go and record this gain, my contingent consideration. Right. So I have plus 1,800. So basically I have to pay, I have to make this contingent consideration of how much 1,800, meaning I have to debit my investment cost. I have to pay this. So I have to credit my liability. So I'm going to credit my liability as well. So I come here, I'm going to say, go to my liability plus 1,800. But as at the year end, what is actually happening? The liability is reducing. Am I right? Guys, whatever I have to pay is coming down. Now that my liability is coming down, it is again, it is an income. Therefore, I have to account an income as well. So two things, again on deferred liability, and my liability is coming down. So how much is my gain? I come here, 300 is my gain. So I come all over here. My retained earnings gain on deferred liability. How much is the gain? I make a gain of 300. I'm going to put here. My liability is reducing. So I come over here. 24,600 minus 300. Are we clear? Yes or no? Are we clear, everyone? Yes or no? Everybody. Are we clear? Yes or no? No. Okay, I've got to know. So I'm going to explain it again. Okay, Shahtia, you with me? Okay, brilliant. Shahtia, basically what is happening here? Here, do you understand that I had to pay 1.8 million? Now I'm paying only 1.5 million. I had to pay 1.8 million. Now I'm going to pay 1.5 million. Correct? Correct, yes or no? Now I have to account for my 1.8 million. No, that is my 1.8 million here, 1,800. But year end has come down. So my recognition itself has not been done. So I'm going to immediately recognize because I have not recorded my contingent consideration. How will I record? I will debit my investment cost, 1,800, and I have a liability to pay. No, so I'll credit my liability. I have 1,800. That did you understand? Yes or no? That did you understand? Yes or no? Yes, you understood that. Abdullah, you understood that? Yes or no? Now there is a reduction in liability. No, I thought I'm going to pay 1,800, but now I'm going to pay only 1,500, meaning 300 a reduction. This 300 becomes a gain for me. No, so that gain I have to add it to my retained earnings. No, there you go, retained earnings 300. And my liability is reducing. No, I credit my retained earnings, increase my retained earnings, my liability is reducing. So I remove it from my retained liabilities minus 300. So technically I have to pay only 1,500. Now clear? Got it. Super. Now guys, entirely I've covered this point. Entirely done. Entirely this point is covered. Nothing to worry. So let's go further. We come here. Steps, always steps. And on top, we are done. Step 3 done. Step 4, I'm going to do my adjustments. Adjustments, my intergroup transactions, items in transit, unrealized profits, fair value adjustments, fixed asset transfer, connection. There can be something connected to an accounting standard, whatever. But when I do it, everything at acquisition must be noted. I'm going to write down separately. Okay, I'll tell you how to do it. At the date of acquisition, in the exam, this is a very important point. At the date of acquisition, the term acquisition at the date of acquisition means relevant for our goodwill calculation. At the date of acquisition, the fair values of South Star's assets were equal to their carrying amounts, with the exception of a property. So all the net assets, when you acquired, when you did a fair value calculation, everything was okay, no problem, but except for a property. This property had a fair value of 2 million above its carrying amount. Now the value has gone up by 2 million of the property. Okay. Above the carrying amount. Stop there. 2 million above the carrying amount means what? There is a revaluation gain. So basically, you have to account for the revaluation gain. So let's go back. Polestar. Next point, working number 4. Working number 4. Revaluation gain. How much is the revaluation gain? The revaluation gain is going to be 2 million. So revalue property, plant and equipment by 2 million. How do you do that? You come to the top. There you go. there is revaluation reserves. That's the reason why we put this up very early. There is a gain of how much? 2,000. I go to the top. My property, plant, and equipment should go up by 2,000 plus 2,000. Understood? Yes or no, guys? Did you understand that? Yes or no? Guys, did you understand that? Yes or no? Very simple adjustments, guys. Don't complicate things, okay? And had a remaining useful life of 10 years at that date. So you had 10 years remaining useful life. So basically, this revaluation is not captured, no. Because this revaluation is not captured, the depreciation is not also not captured. But like I told you, one thing that you need to keep in mind is here, when is this happening? This is happening at acquisition. Therefore, this particular revaluation, you need to mention A at AQ. At AQ means this becomes relevant for my goodwill calculation. Okay, keep that in mind. We go forward, meaning I'll be using that later. W5, you have depreciation. They say remaining useful life of 10 years at the date of acquisition and all depreciation is included to cost of sales. So this 2000 which you have was not depreciated. So 2000 over 10 into you are acquiring it for 6 over 12 months. It's been acquired. So since the date of acquisition, 2000 over 10 into 6 over 12 gives you 100. Gives you 100. Are we clear? So 100 is the depreciation which has to be deducted from our retained earnings. So I come to the top, I go here, I will say depreciation minus 100. And I go to the top from my property, plant, and equipment. Obviously, I have to account for depreciation minus 100. Understood? Yes or no? Understood? Yes or no? Guys, only revaluation will be affecting our goodwill calculation. Depreciation won't affect. You know why? Because depreciation affects post acquisition. So everything at acquisition is relevant for our goodwill calculation. Okay. Working number 6. Polestar's transferred raw materials. Okay, obviously there is an intergroup transaction. So intergroup transaction. So what is happening? Polestar transferred raw materials. Listen to me. At their cost of 4 million to Southstar in June 2013. During the year, Polestar is transferring to Southstar. So P parent sells to subsidiary. How much are they selling? The value is 4,000. Southstar processed. So they processed all the materials, incurring additional cost of 1.4 million. They're incurring a cost of 1.4 million in total. And they have the material with them and sold them back to Polestar. So one, Polestar is selling to Southstar, and then two, Southstar subsidiary is selling to Polestar. So there are two things. Parent selling to subsidiary, subsidiary selling to the parent. How much are they selling it for? 9,000. Therefore, sales of both between the parent and subsidiary in total will be 13,000. Any intergroup transaction will be eliminated. So there you go, eliminated. Are we clear? Okay, guys, one thing I think we actually forgot about the income statement. So I have missed out the adjustments to income statement. So I'm gonna work the income statement adjustment as well. So basically we have to do it together. Okay. So we were focused on the balance sheet. We forgot the income statement. So I'm going to show it to you right now itself how to adjust. Now look here. Okay. Before going there, did you understand this particular element? Yes or no, everyone? Did you understand this? Yes or no? This 13,000, did you understand? Yes or no? Everybody respond. Okay, super. Now, let's go back. from here, right? We've got revaluation, we accounted for revaluation, no problem. But after that, we have depreciation. Depreciation, guys, remember, we adjusted here minus 100. We went to property, plant, and also adjusted, no, correct? What your examiner says, it has to go to cost of sales here, correct? So cost of sales means you come here, under your cost of sales, you will add 100. Are we clear? Did you understand that? Everybody, yes or no? Did you understand that? Yes or no? Did you understand that? Yes or no? Okay. That is number one. Number two, guys. Okay. Number two, guys. Now, this is done. Number two, guys, there is a decrease in liability which we spoke about. That is an income. So basically, that is an income. So basically, that has to be accounted also. We accounted that in our liability, and here no retained earnings, no. So in our P&L also it has to be accounted, right? So we come to the P&L, we come to operating expenses minus 300. We'll deduct 300 there. It's easy. Makes our life easier. Are we clear? Well, basically, Abdullah, we are going to show NCI separately. So it will be adjusted when we show NCI. Don't worry. Take 100% and then we will make it, we'll make the changes below. Okay. Guys, do you understand? Are we clear? Okay. Here, what I did not, okay. Now, Atura, what's happening here is you are making a gain here, no? 300. Do you understand? You're making a gain. That gain we adjusted here, right? Here we adjusted and we adjusted in current liability. It's a gain, no? So basically my profit should go up, no? So I'm coming to my operating expenses. From operating expenses, I'm deducting. My expenses coming down, meaning my profit is going up. Are you clear? Understood? Okay, brilliant. Now, we were here, we were looking at this. 13,000 eliminated. Now, 13,000 eliminated, what is this? Intra-group transaction eliminated from sales and cost of sales. In other words, we don't have purchases. How much should I eliminate? 13,000. I go to the top. I come here. I have my revenue. From revenue, I deduct minus 13,000. From my cost of sales, I deduct minus 13,000. Understood? Yes or no? Understood? Yes or no? Everybody understood? Yes or no? Brilliant. Now coming back. Others, everyone. Everyone, I'm waiting for you. Nope, no impact. No impact. Statement of financial position is not impacted by intergroup transactions. Only intergroup balance has an impact. Okay. Brilliant. So there you go. We are here. That's done. Eliminated. At 30th September, Polestar, that is the parent, had 1.5 million of this goods still in inventory. So that means subsidiary sold goods to the parent. 1.5 million is there. So working number 7, I have unrealized profits, URP. How to calculate URP? Normally, your examiner will give you the profit element. If the profit element is not given, very simple, guys, try to understand. Total cost incurred when subsidiary sold it to the parent was 4,000 plus 1,400. No, that's the total cost incurred. No, correct. That's the total cost that they are selling it for. Am I clear? So the profit element will obviously be, when they're selling it for 9,000. So equals 9,000 minus 5,400, 3,600. Out of this 3,600. So now this is the cost, sales price. So your profit element would be, your profit element would be 3,600 into over 9,000, which is 40%. As a percentage, it's going to be 40%. So how much is the inventory, remaining inventory? Remaining inventory is 1,500 at 40%. That's going to be equals 1,500 into 40%. 600 URP has to be eliminated. Eliminated from whom? Eliminated from subsidiary, because subsidiary is the entity selling. So because they say Polestar had 1,500. So meaning subsidiary had. Are we clear? Are we clear? Are we clear? So how do I eliminate? I go to my assets, current assets. I come to my current assets. From current assets, minus 600. Subsidiary is selling. So I go to my subsidiaries retained earnings. Over here, URP minus 600. And then, of course, I have to remove it from my inventory. I go to my cost of sales. To my cost of sales, I add 600. Done and dusted. Understood, everybody? Yes or no? Any doubts there? Any doubts? Any issues there? Any doubts? Any issues there? Any doubts? Any issues there? No. Understood. Explain again if possible. Okay. Now, listen. First thing, Polestar parent sold goods, transferred goods, raw materials, that is raw materials, unfinished goods at a cost of 4 million. Here, this is this 4 million. No? Did you understand that? 4 million. And then subsidiary is selling back to the parent for 9,000. They're doing some processing and selling back. Okay. Therefore, in total, there is 13,000 worth of transaction sales that would have been accounted by the parent and by the subsidiary. Now, this 13,000 is, when you combine together, that's the intergroup sales. No, that has to be eliminated. No, I eliminated that. Understood that? Yes or no? Understood that? Yes or no? Okay, super. And number two, when subsidiary sold the goods to the parent, they purchased it for 4,000 plus there is a direct cost of 1,400 now. So therefore, total cost incurred by the subsidiary is going to be 5,400. And they're selling it for 9,000. No. Therefore, there is a profit element of 3,600. So on your balance inventory, which is within the group, which is unrealized, you have to calculate URP, no, guys. For the URP only, you need to know the profit element, no. That profit element, how to calculate? 3,600, that is your profit, over your sales price 9,000 as a percentage, which is going to be 40%. Understood? Yes or no? Okay, brilliant, super. Okay. Polestar's policy is to value the NCI interest at fair value at the date of acquisition. This was seemed to be 3.6 million. Okay, this is to calculate NCI goodwill. All items in the above statement of P&L are deemed to accrue evenly over the year unless otherwise indicated. So that means they want us to apportion the incomes and expenses. Are we clear? Okay, I'm going to give you a quick 2 to 3 minutes. I want you to go and look into these adjustments. I want you to go and look into these adjustments to understand if you understood and give me a done. Okay, quickly go through and give me a done. Go through the question entirely. I want you to go through and then obviously the answers and give me a done. Guys, if you're done, give me a done, okay? Just give me a done that you're done so that I know. Intergroup transactions only gets deducted from P&L, statement of P&L. That's right. Consequently. If you have intergroup balance, then yes, it will be deducted as well from the statement of financial position. That's why I spoke to you about items in transit. Can I continue? Are you done? Everyone, can I continue? Yes, can I? Okay, guys, like always, we go back to the steps, right? Steps, adjustments, 1, 2, 3, 4, 5, whatever the adjustments comes by, you're going to work around it. And then finally, you're going to calculate. Oh, there you go. Calculate first goodwill. Goodwill on acquisition. That's the first thing that you're going to calculate. There you go. First, goodwill on acquisition, then consolidated retained earnings, then NCI share of net assets, and consolidated revaluation reserve. Okay. First, goodwill, goodwill, goodwill. Okay. Don't miss that. I'm so sorry. Miss that. Okay. Anyway, coming back, we are here. Working number 8, my W8 will be consolidated. Sorry. Goodwill on acquisition. Goodwill on acquisition. Okay. There you go. Goodwill on acquisition. That's my working number 8, W8. Okay. For goodwill, very simple. I need the investment cost. I have to deduct all acquired net assets. Now I have my parents' goodwill. I have my subsidiaries' goodwill in the exam. Okay, there you go. So parents' goodwill. So I'm going to take the investment cost. What's my investment cost? Don't forget, we already calculated on top. Guys, you got to be very well focused, so you can connect from here to there. You can connect, right? So immediate cash payment was 13,500, and then I have a deferred payment of 1,800. So therefore my investment cost will obviously be equals. In the exam, I would prefer to connect 13,500 plus 1,800. I will have a total of 15,300. Guys, whatever you take into the goodwill calculation, you don't take into the consolidated financial statements. For example, investment cost is 15,300 here. No? Immediately as I take, I go to the top and I will see my investment cost here is 15,300. From here, I will deduct 15,300. Guys, it's consolidation adding. And we got to make sure there's no double counting. So I deduct my 15,300, making this zero. But instead, I will try to accommodate my goodwill. So let me go forward. Investment cost done. From this, I deduct my acquired net assets. Acquired net assets means what are the assets that I'm acquiring at acquisition date from the subsidiary. Subsidiary is there. Whatever I'm acquiring from the subsidiary, I have to take it. For example, I'm acquiring my net assets share capital here. It's easier for us to take the share capital. So I come here, my share capital examiner has given me 6,000. So I'm going to take 6,000. And then I have retained earnings. Now, retained earnings, guys, like I told you, goodwill is at acquisition. Therefore, this retained earnings they have given me here is not at acquisition. Now, this is an instant a scenario where most of the students struggle. You got to be very vigilant that you are only taking goodwill, which is for goodwill you take retained earnings, which is relevant. In other words, which is at acquisition. Now, here, this is the balance sheet date 12,000. That is your retained earnings here. But if you look here, this is at 30th September. We already drew the timeline. 30th September over here, we've got the retained earnings, which they say is 12,000. But is that relevant for us? Actually, no. Not for my goodwill calculation. They say 12,000, that's not relevant. Where do I need my retained earnings? I need retained earnings for goodwill at this point at acquisition. How do I get it? It's not a challenge. It's very simple. It's very, very, very easy. When you look here, this is 12,000. Remember, don't forget. But in the current year, subsidiary is making the subsidiary's profits or losses are given. But in this instance, it's a loss. So basically, if you look here, during this period, they have made 4,600. Since it's a loss, technically, as you started off, you would have started off with 16,600. You would have started off. You would have made a loss and now you're at 12,000. So if that is the case, what would have been your acquisition retained earnings? What would have been your acquisition retained earnings? Think, use your kidneys and tell me, please, what would have been your acquisition retained earnings? What would have been your acquisition retained earnings? $4,600 is for how long? 4,600 is for 1 year. So here you have a period of 6 months to cover, here 6 months to cover. At this point, what would have been the retained earnings? Think and tell me. Come on, you can't take this long for it. Okay, Shibi, good. Shibi, good one. Closing retained earnings is 12,000 given Amani. That's not the problem here. All what I want is here, at this point, what would have been the retained earnings? It's a 2,300 loss. Brilliant. It's a 2,300 loss, which is between here 2,300 and 2,300. So technically, if you're going to work backwards, 12,000 plus 2,300, which would be 14,300 equals 12,000 plus 2,300. If it is profit, it would have been the opposite. Are we clear, everyone? Are we clear, everyone? Yes or no? Everybody, are we clear? Yes or no? Everybody. Guys, everybody, do you understand that? Yes or no? Understood. Okay. Now that is done, I will go and look for all the adjustments relevant for at acquisition. What are the adjustments relevant for at acquisition? I would have already put, see, revaluation at acquisition relevant, I say. So I'm gonna look for everything. Depreciation, it's not relevant. Intergroup transactions happens post acquisition, that's out. Unrealized profit also happens after post acquisition, that's out. So basically, the only thing that is relevant is revaluation. Our revaluation, when we acquired here, there is nothing. Therefore, at acquisition, they have not given anything, zero, and there is a gain in between, and the gain is going to be 2000. I'm done. I'm going to take my total. There you go. In this, I'm acquiring 75%. So 22,300 into 75%, 16,725 equals 15,300 minus 16,725. 1425. 1425 is my loss. Listen to me very carefully. I'm going to explain you what this loss is about. Here, there you go. Your examiner clearly says it's a bargain purchase, my dear. It's a bargain purchase, my dear. It's a bargain purchase leading to negative goodwill. It's a bargain purchase leading to negative goodwill. It's a negative goodwill. A negative goodwill. So if it's a negative goodwill, we call it a bargain purchase. Purchase. Can you include negative figures in the financial statements? You can't include. Well, in simple terms, with your net assets figure, whatever you have paid is a lesser amount, meaning you've made a profit. When you've made a profit here, add to retained earnings in the balance sheet. Statement of financial position. That is the first thing that you have to do. Second thing, it's a gain, add to the P&L. To profits, take it as a gain. Two things. I come here, my retained earnings, there is a gain. Amani, are you with me? So there is a gain, parent has a gain of 1,425. Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Gain. So gain on goodwill. That is number one. Number two, yes, you go to your P&L from operating expenses minus 1,425. This is coming down. Very simple. Okay, that is done. That is done. My bargain purchase is done. Now I go to my NCI goodwill. Not just that, we are supposed to calculate NCI goodwill. My NCI goodwill, I need my investment cost. What's my investment cost? We know your examiner has given you. They say the investment cost is 3,600. Are we clear? It's 3,600. Yes or no? Yes or no? So from the investment cost, I will deduct acquired net assets. My acquired net, I've got 22,300 from here. 22,300. In this, I have 25%. Equals 22,300 into 25%. 5,575 equals 3,600 minus 5,575. 1,975. Once again, it's a negative goodwill. Negative goodwill for what? Negative goodwill for NCI. If NCI is negative goodwill as well, they have also purchased the company at a discount, at a low value. In that case, what you do, listen to me very carefully. NCI, what you have to do, it is once again, add to parents' retained earnings. It's a gain, number one. Number two, add to P&L because it is a gain. That's done. And then finally, deduct from NCI share of net assets. Meaning NCI share of net assets is the next thing. If the parents' retained earnings is going up, this has to come down. So the next working, whatever we are going to do, we are going to reduce the NCI share assets value. So there you go. My next working number one, like I told you in terms of my consolidation, I'm done with my goodwill. Once I'm done with my goodwill, yes, technically the second thing, although I put here consolidated retained earnings, I want you to calculate NCI share of net assets and then its consolidated retained earnings. So I'm going to make a little change there, NCI, and then I want you to calculate consolidated retained earnings and then consolidated revaluation reserves. So next, NCI. So NCI share of net assets. Net assets. The moment you come to get to this point, your NCI share of net assets can be calculated. How do you calculate? You require your share capital. If you have share premium, obviously that, and then your retained earnings, whatever is lying under your equity, and then revaluation. Your share capital, obviously, your share capital is given here at 60,000. So no change there. 60,000 retained earnings as of today. NCI share of net assets at balance sheet date as of today. Now, for this reason only, we make adjustments here. Oops. For these reasons only, we make adjustments here. Where? Here. Now, at this point, I'm going to take my total here. And I'm going to take my total here. 11,300. What is subsidiaries retained earnings? Subsidiaries retained earnings is 11,300. I go to the top. I connect my 11,300. And then revaluation, that also as at the balance sheet date, I've made changes here. 0, 2,000. There you go. You come here, you can take the revaluation of 2,000. You have the total. Therefore, your total NCI value will be 73,300. Out of this 73,300. So it's not 60,000, it's 6,000. Okay. 6,000. I'm sorry. 6,000. It's going to be 19,300. I'm sorry. It's 19,300. In that, NCI percentage is 25%. Therefore, equals this into 25% gives you 4,825. This is the NCI share of net assets, but you have negative NCI goodwill. Here you can have shortcuts here. You can say GW, all those are fine here. No problem there. Equals from here. I'm going to bring 1975. Therefore, my total sum will be 2,850. That's my NCI share of net assets. Well, if you really want, there is another shortcut you can apply in the exam. Your shortcut is going to be your NCI investment cost. Your NCI investment cost, is 3,600. NCI investment cost is 3,600. To this, add PAP. PAP means post-acquisition profits. Post-acquisition profits is PAP. From the point of acquisition till today, how much is the profit? Okay, so today, at acquisition, today the profit we know it's 11,300. At acquisition, retained earnings is 14,300. So minus 14,300. Therefore, my sum is 3,000. In that, 25% is NCI equals this into this is 750. Therefore, 3,600 minus 750 gives you 2,850. Either way, you'll get the same answer. For MCQs, you can use this shortcut. But if you're doing a full consolidation question, I would recommend you to do the other one. Because if you do this, you will not be able to get the NCI goodwill. Because if it's a positive parent goodwill, probably you'll have to take the positive NCI goodwill and add it together and present it on top. Because of that. Are we clear? Do you understand? Do you understand? Yes or no? Super. My next working is going to be working number 9. This is going to be working W9. And then I'm going to have my working 10. My working 10 will be consolidated retained earnings. Like I've told you in the exam, keep this as your balancing figure. Don't calculate. Don't calculate this in the exam. Just leave it like that. That's okay. Just move on. My screen is blurred. Is my screen blurred? Because the weather is horrible here. No, okay. Some say no. Okay, fine. Guys, your Indian question, please check that also, okay? Working 11 is consolidated revaluation reserves. Consolidated revaluation reserves, how I can calculate? You take parents revaluation. Where do you take parents revaluation? You have already calculated here. You go to the top equals 0. And then subsidiary today and at acquisition. Today, where do you get it? Subsidiary today, you get it here 2000, because our NCI has all figures relevant for today. Acquisition, our goodwill has all figures relevant for our acquisition 2000. 2000 minus 2000 is 0. Therefore, our revaluation reserve is also 0. My consolidated retained earnings in the exam, I will not calculate. I will not calculate. Guys, listen to me. You should not calculate. Why? Because you can get it as your balancing figure. Now I'm going to go to the top and I'm going to start balancing my question. Are you all ready? Are you all ready? Okay. Goodwill, I don't have goodwill because it is negative 0. Investment in associate is not there, it's 0. Therefore, my total here is 63,900. Total non-current assets. My total current assets is 23,200. Therefore, I have my total assets, which is 87,100. Okay. And then I'm coming to my equity, consolidated retained earnings. I did not calculate. I'm going to just leave it like that. Consolidated revaluation reserve is 0. My NCI share of net assets, I calculated it. So equals, I have my NCI 2850. 2850 is my NCI. So I take my NCI 2850. That's it. I have to get my total equity and liability. Now, this is where you're gonna be very smart in the exam. Equals 87,100 because it has to balance, no? So equals 87,100. Therefore, your consolidated retained earnings will be your balancing figure in the exam. Please take it as the balancing figure in the exam, meaning equals 87,100 minus 30,000 minus 2,850 minus 24,300 gives you 29,950. That's your answer in the exam. I don't want you to calculate that in the exam. Are we clear, everybody? Are we clear, everybody? But for the purpose of proving it, I'm going to show you proof here. Okay. Because you must not think, we're just trying to manipulate here. No, because in the exam, under exam conditions, it's all about going further. It's not about doing one question. It's about finishing the entire paper. I'm going to prove it here because it is a fully fledged class. In the exam, I don't want you to do it because I want you to not get confused. Will you be penalized? No, don't worry. You're fine. So I want parents retained earnings. Parents retained earnings is how much? We calculated it. 30,000 to 25. And then where is my reserves? There you go. What do I feel like something is missing? 30,000 to 25. Yeah, correct. But guys, look here. We took 1425 gain. We did not take 1975 gain. Now look here, add to parents retained earnings. So we have not taken that. So I'm going to come back here. NCI goodwill gain 1975. Here I have a gain. So my total will go up to 32,200. That is one entry. And here, since it's a gain, I have to come here. I'm going to reduce my operating expenses by 1975, making it 7,000. There you go. I'm going to prove 32,200 today. Subsidiary, you're going to take today and at acquisition. Today, let me come to that Shadia. Today, it's 11,300 today. My subsidiary is retained earnings. There you go. And when I acquired, it is 14,300, meaning equals 11,300 minus 14,300 gives me 3,000. But in this 3,000, how many percent is mine? How many percent is mine? 75% is mine, who consolidated retained earnings. Into 75%, 2,250 negative. Therefore, 32,200 minus 2,250, 29,950. Your question is, the answer is correct. In the exam, I don't want you to do this. I want you to take this as the balancing figure. Are we clear? Okay. 1975. Okay, coming back. Shadia, do you understand this entire calculation? Yes or no? Do you understand this calculation? Yes or no? No. NCI is making an investment. When NCI is making an investment, you have to calculate NCI goodwill. NCI is making an investment, so you have to calculate NCI goodwill. How to calculate NCI goodwill? You have to take the investment cost, like how you took it for the parent. The investment cost is 3,600. Where do I get it? I get it from here. Your examiner is given you. Sometimes he'll give you the share prices. Sometimes he will directly give you the figure. Like here, in this case, your examiner has directly given you the figure of 3,600. So I've taken my NCI investment. From this, I deduct my acquired net assets. Acquired net assets, 75% goes to the parent, 25% goes to the NCI. 22,300 in 25% gives me 5,575. In this case, the value is negative 1975, meaning the premium paid is lesser. You are not paying a premium, instead you are paying a discount, which is lesser than the net assets. So therefore, what you have to do is you have to add to parents' retained earnings. How to add to parents' retained earnings? I've just added to parents' retained earnings. There you go. 1975. That's the first entry. So my gain is going up. So I'm coming to my income, to my P&L. There you go. My operating expenses, I'm reducing it so that my profits will go up. Second entry. Are we clear? Shahadia, have you followed classes entirely, or are you a new student? Just to understand your background. So why is loss added instead of why is the loss added instead of deducting it to return? It's not a loss, Arudra. It's a negative figure, meaning it's a gain. For example, this watch is 100,000. You pay 90,000. Okay, so you're paying less. So you're paying minus 10,000, but it's a gain for you if you do it. Okay, meaning you have not followed lectures with us. Have you been a student here, or you are a new student? I'm just trying to understand if I can help you anyway. Okay, fine. Just drop me a message. I'll see how I can help you. Okay. Brilliant. Okay, now that I'm done with this, I can work on my P&L. There you go. 20,700 minus 7,000 gives me 13,700 as my profit or loss before tax. And then I have my tax, which gives me 10,700. Now what I have to do, this is my group profits. And now I have to do my NCI share of profits. NCI share of profits is very simple. I'm going to take my subsidiaries profits. How much is subsidiaries profits? Subsidiaries profits are given here. 4,600. Subsidiaries profit is 4,600. But 4,600 is for 1 year. So into 6 over 12, which is 2,300. But it's a loss. So I'm going to make it a negative loss. Any adjustments to this will be taken into consideration. I remember we had depreciation. Abdullah asked me, why aren't we giving it to subsidiary? There you go, NCI, 100. Now I'm bringing it here, Abdullah. Abdullah, answering your question, minus 100. And also in this case, what else is affecting, depreciation is affecting, URP is affecting because subsidiary is selling goods. So there is a 600 minus. So I'm going to come to the top. I'm going to deduct my URP minus 600. Well, anything else? I don't see anything else that is affecting my subsidiary profits. Therefore, I take the total, which is 3,000. Out of this 3,000, how many percent is NCI? 25%. So equals 3,000 into 25% minus 750 is my NCI. Now, if you really want, this 750 is taken from here. You can take today minus acquisition into 25%. That will be your 750. Are we clear? Everybody. Are we clear? Everybody. Okay, brilliant. I believe I've made some impact to your studies with this question, but just drop me a message if you want any other questions to be done. I'll try to accommodate it during our marathon session. Okay. Next, I will be also looking at a P&L balance sheet question, another P&L balance sheet question tomorrow. I'm going to work on a P&L balance sheet question covering adjustments and accounting standards, including IFRS 9, if we are able to capture it. So guys, thank you very much for being a part of the session. Tomorrow, once again, let's meet up at 6:30. Let's go on till 8:30. Yes, this Excel sheet will be there for you. We will be sharing it with you. Until then, take care. Sorry for the inconvenience. I know the weather wasn't great. Sorry for the inconvenience, but let's catch up very soon. Take care, guys. Bye-bye. Have fun.